Welcome back to It's Only Money with financial advisor Scott Brown with Edgewater FamilyWealth.com. You can reach Scott at 407-648-1881. Well, good morning.
Yeah, man. Good morning. Excited to be here and not in the Ukraine.
Yep. It's let me tell you, Scott.
Tell me.
So as a younger person, I keep all my when I got my 401k options, right? They said, "How do you want to do it?"
Wait a minute. Let me just stop you. So you're going to tie your 401k into the Ukrainian crisis? Right?
Absolutely.
Okay. I just wanted to make sure I knew where you were going here.
So, it was like you can do it steady, or there was all the way at the bottom, super risky, right? I forget what the actual wording was, and I was like, super risky. Why not? I got time to recover, and over time, it's actually been pretty good. And then this week, red, all the way down. So I'm now seeing how a global conflict can affect me here in Florida.
Yeah. So you talk about, it's been all good. So all good is what, the last decade or so that you've been doing this? So you're a young man. So this is the challenge of the young person, right? Is to say, they say, well, it's markets go up because as far as you know, they do, right?
As far as I've been doing it.
Yeah.
Right. It's made me look like a genius.
Right. That's where I was going. Clearly, you're a genius because your market only goes up, right? I think somebody once famously said, don't confuse a bull market with brilliance. I believe you may have fallen into that category. So, yes, our statements are going to start to bleed a little bit. We can talk about the Ukraine in a second, but I do think that's a problem for a lot of young investors who have been in the market for the last 7, 8, 9 years thinking that this volatility is only up, right? Mm-hmm. No, you're finding out quickly that volatility, and for those of us, people like me who've been doing it for 35 years, if this turns out to, and technically we are in a bear market, if this continues, this will probably be my 5th or 6th bear market. So I've been trying to advise not only young people, but even young advisors in my business have never been through a down market. Quite a few of the individuals I employ in my practice have never seen a down market. And I'm not sure even they believed that a day like this might come. So I've been pounding it into them. They've been largely ignoring me and telling me to go away, you old man. Stop chasing kids out of your yard. We're going to be just fine. But now I think we're finding out, okay, geopolitical risk is there. There's inflation. There's all kinds of things going on that are contributing to this formula, not the least of which is the market's done very well. So when the market has gone through an extended period of time like it has, it's not unusual to see trading, large trading blocks moving positions out because they're up. They want to take those gains. Maybe this is an excuse. Maybe it isn't. Maybe there's some fundamental reasons that the Ukrainian crisis might affect your portfolio. But the reality is, it's a small percentage of the world's economy. Tammy, who is here with us today, who's my CFA candidate, what percentage of the world's economy does Russia actually, and certainly not, the Ukraine's not even worth talking about, but what does Russia represent?
Less than 2%.
Okay, so what we're talking about is a situation in a part of the world that really affects 2% of the world's economy. Now, that's not nothing, but it's not that much. The U.S. is closer to 30% of the world's economy. And if you look at the markets today, Tim, you just told me the market's down about 2%.
Yeah, about 2%.
The Russian market's down.
Oh, it's very steep. It's like we're talking 40-50%.
So we're winning that.
Oh, good.
It's 40-2 there. And that's ultimately what we're going to need to win there, obviously, to bring about a conclusion that is somewhat satisfactory. So, if you think about and by the way, where's the ruble? Is it down?
Oh, the ruble has been suffering. So the past 2 weeks, we were looking at 5% depreciation. And as of this morning, when the news broke out, we're looking at about 15% drop.
Yeah.
So now we're at 85. It's pretty bad.
How's that for inflation if you're a Russian, right? We're over here whining about 7%. They just took a 15% hit in a day.
Oof.
To their ability to buy milk, chicken, eggs, etc., vodka, of course. Let's just stereotype Russians right away.
No, I've seen the shops. I've seen the shops.
What are they going to have for breakfast? They're out of vodka. But, no, the reality is that this is going to have a much larger impact on their economy than ours. That doesn't mean it's not having an impact on ours.
Well, It's definitely having an impact on my day. But I'm like, as you've told me to stop doing, I have a heavy crypto investments, and I'm going to stop doing that immediately. Or do as the meme saying, keep buying the dips. God, I know I
Talk to me about your crypto. Talk to me about what did you just tell me Bitcoin was down today?
It's down to 35. Yeah, 35.
Which represents what percentage drop?
A 23.5%.
In one day.
Yes.
So again, tell me how it's a currency. Like you got in your car, right? It's like noon and you're like, I'm going to McDonald's. And because I know that's where you like to eat.
Yes.
And you're in your car and you're on your way to McDonald's and you're like, I got $7 for my Happy Meal and my milkshake. And then you get there and your $7 is only worth $4. That's really what we're talking about with crypto, right? So if you think it's a currency, by the time you get to McDonald's and you can only buy a small fry, that's really not a currency.
I will learn one of these.
I mean, I know you're a
days.
supersizer. I don't get me wrong. I understand that, but
now with the bear market thing though, is literally something you're right. I don't understand it because I've just done good, you know, and it seemed like I was a genius. Everybody I know. Genius.
Yeah, clearly.
How do you prepare for a bear market? Like, is it like the equivalent of financially hoarding food?
Well, it's diversification, and people hate to hear this because it's kind of boring, and we're going back into unsexy land here. But diversification is a great equalizer. So there's nothing that's going to get you out of the way of a 10, 15% decline. Listen, if the market's, I don't care what stock you own. I don't care if you own Apple or you own Microsoft or you own Bitcoin. If the market drops 10, 15% in any given short period of time, your good stocks are going to be down. Your bad stocks are going to be down even more, right? And conversely, if the market's up 10% in a month, you are a genius because everything's going to be up. You know, there's been studies done that say that 90% of the return of an equity is market-based. And what I mean by that is if the market's up, most stocks are going to be up, right? There's probably 5% you can attribute to a sector. So if we say, yeah, the market's okay, but oil's really doing well, so the energy sector may represent that 5% factor. And then the other 5% is luck. You just had some good timing, right? So 90% is market-driven, 5% is sector-driven, give or take, and the rest is, wow, you got lucky when you bought it that day.
Now, the stereotypical advice I've always heard at this point from the other geniuses though is that the millionaires are made when the market is down, because that's when you're supposed to take. Now, don't listen to my fun stuff. I'm asking a question. You take your money when it's down, if you have it, and then you buy all the stuff because it's definitely going to go back up. Is that true?
On average, yes. So you're scaring me because you're actually right. So when you think,
it happens once in a while.
I don't know what is going on here. So no, the truth of the matter is be courageous when others are fearful and fearful when others are courageous. And that's how we approach the markets. And somebody might say, and I've had this conversation numerous times in my career where the market drops substantially in one of those 5 or 6 periods I've mentioned, and the client calls up and says, no, Scott, you don't understand, which is always a fun way to begin a conversation. What don't I understand? You don't understand this time it's different, right? This time I don't think it's coming back up. I think we're down 15, 18, 20, 40%, whatever the number is. It ain't coming back. So I said, okay, walk me through this then. Walk me through it ain't coming back. Because if what you're saying to me is that AT&T, Microsoft, Pfizer, Medtronic, Exxon, Chevron, Coca-Cola, Pepsi, Caterpillar, you're telling me that all of these companies are going out of business, right? And they're never coming back. And you believe that we should be invested in a way that protects you against that. What you should be invested in is gunpowder and corn seed at that point. Because what you're saying is that's an apocalyptic situation and none of it's coming back. If you don't believe that, then yes, you're buying on the dips.
Interesting. And it's funny, too, because, obviously I've never lived through a Great Depression, but I remember things like history classes and whatnot, and they used to think things called panics, right? And and that would happen every 10 years. And we don't have that anymore necessarily.
Till
now. Are we just out of, you can answer in the next segment. Is there a way we can technologically get out of ever having dips again?
You told me to answer in the next segment.
And we'll be right back with It's Only Money with Scott Brown of EdgewaterFamilyWealth.com. If you need Scott, call 407-648-1881. We'll be right back. Welcome back to It's Only Money with financial advisor Scott Brown of EdgewaterFamilyWealth.com. Again, if you need to get a hold of Scott, it's 407-648-1881. And before I went to break, I asked you probably the dumbest question, but interesting question for me nonetheless, which is, can we as a society get to a point where we stop having downs in a market, or is this something we're always going to live with every 10 to 15 years?
The short answer is no, because we're a capitalistic society and our markets drive our capitalism, right? It's where revenue is raised or money is raised to invest in and drive new technology, to advance companies to higher, better, more profitable models. So the answer is no, because here's what I say to people. Absent the risk, there is no return. Because if you think about the risk-free rate if you went down to the bank and bought a CD, technically there's no risk, right? I mean, the reality is there's some risk. The bank could go out of business or something could fail. But barring that, you're getting the riskless rate of return, which is nominal, which is not even worth the time of walking down to the bank at this moment, most people would tell you, right? So absent the risk, if there is no risk, there is no return, because that means everybody's doing it, right? So markets are good at adjusting for risk and growing because of risk, but they're also good at people who take bad risks, right? They get rid of you. There's an evolution there. There's a process, right? So the answer to your question is no, because once we get rid of the risk, we lose the opportunity to grow, and that's what makes our markets, as capitalists, we want to take risk. We want people who take risk to prosper, or they won't do it, right? If Bill Gates or Steve Jobs or some of these Elon Musks of the world weren't disproportionately rewarded for taking risk, why would they, right? Because they could go out of business. Elon Musk was on the verge of bankruptcy with Tesla, and he had millions, if not $1 billion to start with. He took a risk with that money to turn that billion into, what's he worth now, Tammy, 100 billion?
Oh, more than that.
Yeah. It's some really large number with lots of zeros. But had he not known there was disproportionate reward versus people who don't take risk, he wouldn't have done it. So we must continue to have risk to seek reward, not only for those individuals, but for us as a society.
Oh, and I like the word capitalist right now, because it just feels like we are capitalists.
We are,
and we go up against Russia, who technically I don't even know what Russia is right now. They're supposed to be capitalists technically, right? I mean, how does it work? Like, it seems like this giant country to me that it takes up 11 time zones, and it's got to be this just economic powerhouse, right?
That is wrong.
What do you mean it's wrong?
So, Tammy, what portion, you just said 2% of the world's economy is Russia, but actually, correct me if I'm wrong, but does Texas have a bigger GDP, for lack of a better word, than Russia?
Yeah, Texas and California. I mean, both of them individually have bigger economies than Russia. Now, interestingly, the share of...
Wait a minute, is Texas going to invade Oklahoma? Is that a possibility?
They get a little crazy every so often, so I wouldn't put it past
I just want to
them.
be clear on that.
That I don't know.
I mean, they are. There is weirdly a mass exodus from Texas happening, I think, at all times right now, which is very interesting to me. But they're always you got to keep your eye on Texas, because every now and then they get some politicians like, we should secede, and they're like, that's never been a good idea.
Yeah.
Just calm it down. So wait, Texas and Russia, same size economically?
Yes.
How is this such a big impact on us at all times then?
They have nukes. Did we give Texas nukes?
Not as far as I know.
Okay, good. So yeah, no, they have nukes, so they get to make noise. I mean, that's we know that in the world stage, North Korea has nukes, so we have to pay attention to them. Otherwise, we wouldn't care. So yes, but from an purely economic standpoint, and by the way, Tammy, how far down are we right now?
For what?
For the S&P.
We're up actually. We're down only 1% from the morning.
So we're already coming back. We're already over it.
Well, there we go.
Yeah.
Because I was worried I was going to have to rush to the gas station and do this. But that's the news story. I'm looking at old Foxy News right now, and it's gas prices are going to go insane through the roof.
Well, I mean, certainly the Ukraine and Russia itself produce a lot of oil and the things we use to power our cars and whatnot. But I don't know that the impact will be that dramatic because we are almost a self-sustaining nation when it comes to energy production. We're very close to that if we're not more or less there. So I'm not. Am I saying gas prices won't go up? No, I'm not saying that. Of course, they probably will go up some, but I don't know. Tammy, how do you feel about it? You think we'll see a major increase at the pump?
Major? I don't think so because whatever's happening right now in Russia, the Russians need customers.
Right.
As it's not just one-way relationship; it's both ways.
Yeah, they need the cash, and
yes.
And with 15% inflation a day, they might need more cash. So
100%.
Yeah. So I mean, the sanctions are going to have an effect. I don't know, obviously, what Putin's thinking his end game is here. I'm not smart enough to figure that out. But I do know if you're thinking on this in terms of pure economics, this is not as big a deal as it is, obviously to the potential loss of life and property.
Well, that's a pretty big deal, I suppose. It's just...
Yeah, I think so.
So I guess it kind of never occurred to me, Davey, which is the fact that, like, you hear, like, Russia, they're producing all this oil, they got it, but we have to buy it, or anybody has to buy it for that oil to be powerful, I guess, to say. Is there a version of, like, them shutting it all down, selling it to nobody, would only really hurt them then?
Absolutely, because what else do they export? It's oil and gas. They haven't developed an economy that builds products like we do or any developed nation. So they need us as much as we need them. And by us, I don't mean the U.S. I mean more like Europe, because they are dependent on their oil. But there are always alternatives. So they don't want them to go and start looking for alternatives because then there will no longer be customers.
Yeah, I mean, it's simple economics for them. Obviously, they can't do this forever and sustain an economy. It's going to have devastating effects on the people, and eventually people get tired of that.
Yeah. And now, at this point, you mentioned earlier about you got to diversify, and that's the only real thing that saves you.
Yeah.
Are you supposed to just, I guess, be already diversified, or in a time like this, is that when you're like, okay, ammo companies, gun companies, that's where I'm investing? Sure.
Yeah. No. So
I'm really bad at this.
Yeah. No, I mean, I always try to think of it like, we always hear about Warren Buffett and his prowess at trading stocks. And the reality is Warren Buffett's just more disciplined than the rest of us. I always say people call up and they're, market's declining, I should probably get out of my stocks. I'm like, yeah, you should do that because Warren Buffett is sitting around waiting for you to sell your stocks at a discount so he can buy them from you. There's always somebody on the other side of the trade. And you have to be saying to yourself, well, I'm smarter than the other person on the person on the other side of the trade. And oftentimes in bad markets, those are professionals on the other side of that trade. So statistically, retail investors, which that's your mom and pops, they go to their local brokerage or wherever they go to trade stocks and bonds and buy their mutual funds and do their things. Historically, they don't do very well against professionals. And it's not because the professionals have a different stock market or a different bond market. It's because professionals have disciplined goals and process. Individuals have emotions. There's been books written about emotional intelligence and how important it is to the everyday investor. And it's been likened to, your emotional part of your brain, the front part of your brain is kind of like an elephant. That's where the emotions are, and you're like the rider on the elephant trying to control it. Once you learn to do, people, they've done studies. They've done studies on people doing cocaine and watching a stock trade. The dopamine fire in your brain, the color scheme that shows up is exactly the same. So people get a dopamine hit from trading because they believe they've done something proactive. But getting back to your original question, which is diversification and when to do it, before the market drops. Because if you're waiting to dig a bunker as the bombs are falling, that's probably not going to work, right? So that's why I'm such a pain in the butt with clients about process and discipline and getting together once or twice a year to say, all right, when things go poorly, which will happen. It may not happen today. It may not happen tomorrow. It may not happen 5 years from now. But it will happen. That's how markets grow in fits and starts. When the fits occur, you should have already prepared your portfolio for that. So when we build a portfolio and then the market goes awry and a client comes in or calls and says, hey, man, what are we going to do? I'm going to say we already did it. We've already prepared for this. Does that mean your statement's not going to look like Swiss cheese for a few months? Absolutely not. It's going to look like Swiss cheese. So what, right? Unless you're retiring to really, the funny thing is sometimes a person will walk in and say, well, I'm 65. Scott, I don't have time for this to come back, right? Well, what does that mean? Are you gonna die tomorrow? And if you're gonna die tomorrow, then it really doesn't matter, right? This is for your widow or your kids. But when you retire, your time horizon is not tomorrow; it's your mortality, which for a 65-year-old is in their mid-80s.
So if you're sitting near retirement today and you feel like you can't retire, they should definitely talk to you pretty immediately then.
Or me or somebody like me. I mean, the advisory.
Scott, we got to work on your marketing.
I know. Listen,
I'm gonna tell them to go to EdgewaterFamilyWealth.com.
And I appreciate that, but I'm not everywhere, and I get that. And certainly, we're happy to talk to anybody who needs help. But really, the idea behind this conversation for you and I is about helping people simplify something that is often made complex. And I think talking to a good advisor, whether you use them or you don't, and you should shop around and ask friends and kick tires and all that sort of thing. Don't kick the advisor. They don't like that. But on average, you should really do some research on who you're talking to, maybe test out a few. But the conversation is more valuable than the stock picking. Conversation is where the process is built and the disciplines are formed.
All right. Well, you can get more great advice like that from EdgewaterFamilyWealth.com. We will be right back. And welcome back to It's Only Money with Scott Brown, financial advisor with EdgewaterFamilyWealth.com. If you need to get a hold of Scott, and I think you should, is 407-648-1881. I'm Ryan Holmes. I don't know if I said that part. I know we have an intro that does it. I love that. Have you heard our intro, Scott? It's pretty good.
Is it?
It is. I believe it's Dan Stone that did it. He's the voice of the station, and I've always wanted Dan Stone to say my name, so that's just a little.
Well, you've made
me.
It, my friend.
I feel like I have.
You have arrived.
I will. It's funny doing this job because it's what I've always wanted to do, which is very cool. And it would specifically this show is what
right. You were hoping to meet me. I remember you saying that. Yeah.
But just to work in radio and to have the 401k and all this stuff, like it feels a little bit better. Things feel a little bit more stable than when I was just a stand-up comedian on the road and all my only investment was bags of Doritos at a gas station on the way to Alabama. So it's a little bit nicer. But the problem is now that I do have a steady source of income and the ability to invest, I don't really know where to put it. Again, like I've said, I've done meme stocks, and that's about it.
Check.
And then I only know the phrase buy the dip, right?
Yeah.
Which means I'm trying to buy the stock as the lowest possible part of it, and that's when I'll buy it. And if I miss that, I don't buy it at all until it does that again.
Right.
Am I doing it correctly?
Yeah, that's not good.
Damn it.
So it's funny because I will talk to either just friends or people or clients or whoever it is, and they'll often say, I really wish, I'd like to own Tesla. By the way, this is not a solicitation to buy these securities because the lawyers will call and yell at me.
Right.
But this is not a solicitation to buy any of these stocks. It's just an example. But people say, I wish I had bought Tesla. Tesla got as high. Tell me what it got as high as like 11 or 1,200 recently.
Oh, it kind of touched up on a 1,400.
Did it touch 1,400? So 1,400 people would say, man, if it goes back, if I wish I'd have bought it at 700. Tammy, what's the price of Tesla right now?
Oh, do we want to go there?
Isn't it around 700?
It's around 700.
Yeah. So if I call that same guy and say, hey man, guess what? Good news. The stock's at 750. You know what he'll say to me? Well, yeah. I mean, I know I said that, but I think it's going to go lower. So what you're saying to me is, in my infinite wisdom that I had 6 months ago, I really wanted to buy the stock at 700. Now I've told you can buy the stock at 700, and you've decided, well, no, 300's better. Right, because as you said, you want to buy the very, very bottom.
Right, that's how you make the most money.
Right, because that's the insight you have as to what the bottom is. Right, you know that.
Even though if it hit 300, I'd be like, it could go lower.
Here's what you know: the stock has been cut in half. You know you like the stock. I'm not questioning whether that's a good idea or a bad idea, but you, in your mind, at least 6 months ago, you thought this was a great company at $1,400, but now it's a crap company because it's $700. And you've decided, well, now $300 is a better price. And meanwhile, at some point, it will probably leave you behind and go back to 8 or 9 or 1,000, and we'll have this conversation over and over again. And to that point, you could say, well, it's down, so it's going to keep going down. That's recency bias. That doesn't mean anything. What it did yesterday has no effect whatsoever on what it's going to do today. So people get caught up as human beings. We're addicted to this recency bias that whatever happened yesterday will happen tomorrow, and it's just not an effective way to invest. If what you do know is that Tesla was $1,500 and now it's $750, and that's less. $750, Ryan, just so in case you're not good with numbers, $1,500 is bigger than $750.
Got it.
So it's on sale. What you don't know is if it's going lower or higher. So what you're banking on is what you don't know instead of what you do know. So if you look at a handful of stocks that basically were carrying the market for the last year, if you look at Netflix, down 38%, Amazon, down 15%, Microsoft, down 16%, Apple, down 12%. Now, if a can of tuna goes on sale at Publix, everybody's running out to buy it. You got to get you some StarKist, right?
Yeah. I don't necessarily go, what's wrong with that tuna?
Yeah. Why? It's been there for 6 months. But if Netflix is down 38%, well, I'm not sure. Well, listen, you're not going to find the bottom. So why don't you take advantage of what you do know?
I guess that, especially with shows like Netflix or stocks like Netflix, I'll look at it and I'll go, well, I do know a new season of The Witcher's coming out. That'll definitely
Ozark, baby.
Ozark will drive that thing way up. But is there a way to really look at it, or is it all like reading tea leaves? I mean, like, what makes a stock go up?
As I said before, mostly the market. Some of the individual characteristics of the stock. Sometimes it's just a story. I mean, if you looked at Tesla fundamentally 2 years ago and you say, well, yeah, that's a stock that's worth $1,500, that would have been a crazy thing to say. But really, Tesla is the promise of a return. It's the promise of a company. It's the promise of a movement. Is it Elon Musk really going to change the world? I remember I was playing golf one day and we were getting ready to tee off, and this is 2 years ago, and somebody said, well, I mean, Tesla doesn't even sell as many cars as whatever, which, by the way, Tesla just passed Mercedes in the number of units shipped. And I said, well, you're not buying it it's not the PE ratio or the dividend, which there isn't one, right? That's not why you're buying the stock. You believe Elon Musk is going to change the world, and some leaders are like that. Steve Jobs was like that. Even before Apple had fundamental earnings and dividend and all of that sort of thing that we care about, price to sales, the things that are important to analysts, we had Steve Jobs. We had a story. We had a belief. We had a movement, right? So sometimes fundamentals aren't all of the story, but in the cases of Netflix and Amazon and Microsoft and Apple, for sure, those are solid companies that have been around for a long time, that are very innovative, and they are on sale.
It's funny that you say that, because all the stuff that I've originally invested in, it was like, yeah, I believed in the story of it, I just liked it. But there's so many companies out there with stock symbols that I don't know what they do. I imagine most people have no idea. Like, the most genius move I ever made one time, I was like, okay, well, electric cars need lithium batteries. I'm going to invest in companies that pull out nickel out of the ground, because those are going to be needed. And then for about 3 weeks, I was a genius. By these random alphabet stocks that I looked up, and I was like, okay, they removed nickel. I need that. And then bam, down, nothing happened. So how do you get behind the companies that have no name, or no recognizable person that's leading them?
Yeah, I mean, and that's the hard part, and that's why sometimes a professional can be helpful, right? And again, they're going to get it wrong too. They're not going to be perfect. Peter Lynch, who was probably arguably the most famous and most effective mutual fund manager of all time, he retired many years ago, ran the Fidelity Magellan Fund. And he was very fond of saying, I don't buy anything that I can't illustrate with a crayon, right? So he would literally follow, back when malls were a thing, he would literally follow his kids around the mall to see what they were buying. And that's how he purchased stocks. So that's not scientific. That doesn't involve algorithms, but it's how he kind of thought.
And every
of
time
value.
I try to follow kids around the mall, Scott, I get kicked out almost immediately.
We have been talking to you about this. But no, the truth of the matter is there's no one way to do it. And there's no one way that works forever, and there's no one way that works all the time. If there were, we would all be doing it. My clients often say to me, Scott, you will tell me when to get out of the market. And the answer is, listen, I like you, Mr. or Mrs. Klein. I like you a lot. But I promise you, if I knew when the market was going to go up and when it was going to go down, I would be living on a private island sipping a drink, not sitting here with you. So again, this idea that there's a person, an advisor or a manager or a guru or somebody on a network somewhere or a book that you're going to read that's going to give you the magic advice is just pure silliness.
Well, if there's a book that people want to read that's definitely not going to give them the magical advice, Scott, you wrote a book. And again, the beautiful marketing. The name of that book is?
I've Never Made Anyone Rich.
And so that one...
This rolls off your tongue, doesn't it?
Yes.
It's like, whoa, I got to have that.
If you want to check out that book, where can they get that?
You can find it on Amazon, which is, by the way, down 15%.
But not because of your book.
It's not my book's fault, I swear. Actually, it may be my book's fault now that I think about it.
It's funny to think, like, it started as a book company, and it still sells books.
Yep.
Technically, it's still a bookstore. Yep. Never walked away.
It's the everything store. It really is. It's the they sell everything.
It's funny because I used to go to Amazon when they moved to CDs. Like they just started selling CDs, but instead of buying the CDs from Amazon, I would get the track list of that CD and then obtain that music.
Obtain was the key
some
word.
Other way.
Yeah.
But that's for another time.
Is that a Napster conversation?
That's a Napster conversation. But if you want to talk to Scott, go to edgewaterfamilywealth.com or again, call 407-648-1881 and we will be right back. And welcome back to It's Only Money with Scott Brown of EdgewaterFamilyWealth.com. If you need to get a hold of him, 407-648-1881. I got a question. In this time of uncertainty that's been happening, fear is a big thing with people just in general. But I've noticed that markets are moved by literal fear. Like people, they tend to scramble. We're emotional beings, you know. Is there a way to just say, like, everybody over here is scared, I can go this other way and make money out of this situation?
Well, I mean, there's obviously not a one-to-one relationship, but there are indexes. Tammy, what's the fear index?
Fear index?
There's actually a market fear index that people track.
Who made this? Ultron?
Yeah, I think so.
So it's as Scott said, it's a fear index. It measures the 30-day moving average and volatility that happens in the market. It just tells you, and you can see it today, for instance, it's up about 9%. Whenever
Scary day, yeah.
Yeah. Whenever you see big movement up or down, you see that index going up. It indicates the movement that is happening. And it is calculated on real time.
Halloween's a big day for the fear index.
Is it really? It's so spooky outside.
It's very scary.
And take all my money out the market.
Very scary.
Goblins are coming.
Kids dressing up as stockbrokers. It's very frightening. So there aren't obviously again one-to-one correlations. People are upset. You can make money. I mean, I don't know that's a thing, but there is the average investor sentiment, which is a contrarian indicator. So we know statistically, the more outflow from mutual funds, stock mutual funds, historically anyway, indicates if that activity picks up, the market's about to turn back up because the average investor tends to react after the fact, after the damage is done, and they tend to get back in after the gains are found, which is why the average investor, on average in the Dalbar study that's done every year, underperform, and I'm going to make up the numbers, but they're close. The institution's 7% annually to 3 or 4% for the average investor, and that's because of the emotion. The emotion, the market is like a giant, what are those things psychologists, like a Rorschach test or
they give the ink blot
test. It's like it tells the emotions of our capitalistic society. There's that word again, but it's an indicator of how we're feeling, right? How is consumer prices? What's the one that measures consumer sentiment? That's the one I'm looking for. We measure these things because we kind of want to get a vibe. What is the vibe? How are we feeling as Americans? What are we going to buy? And there's Ryan, there's so many things that unconsciously we do, not only in regular life, but certainly in investing. One of the things is, silly things like the endowment factor. Like I might meet someone and they have 10,000 shares of AT&T. And you say, all right, well, you should probably diversify because that's 90%. I can't. What do you mean you can't? Well, my dad worked for AT&T. So let me understand what you're saying. Your investment strategy is where your dad worked, right? So what if your dad worked at Enron, right? That might not have worked out so good for you. So that's people believe in, even an even crazier one. Do you know what the number one stock held in the city of Atlanta is?
It's got to be Coke.
It's Coke.
Yeah.
Why? Because Coke's a great stock? It might be. I'm not saying it's not, but that's weird, right? Most people in Atlanta understand Coke. They hear Coke. It permeates their brains, and therefore they own Coke. Seattle?
Starbucks.
Boeing.
Oh.
Starbucks second.
Wow.
So, again, these are not investment strategies, is that I can see their factory when I drive to work.
Oh, man, that's totally why I own Disney now that I'm thinking about it. Yeah. Oh, you got me, Scott.
Yeah, city bias. So, these are things that happen. And the other thing I would say about fear is we know from psychological studies people experience pain at twice the rate they experience gain. So if you think about that in terms of if the market's up 10% and the market's down 10%, you feel twice as unhappy about the down than you did happy about the up.
Yes.
Oh, it's 100%. It's been studied over and over and over again. People, the equal amount of pain is felt twice as badly as the equal amount of gain. We know that for a fact, which is why people struggle to hang on in a down market, because if the market's up 10%, they're like, all right, that's cool. If the market's down %, their hair is on fire.
Yeah.
It doesn't make any sense. It's disproportionate. It's a disproportionate reaction. But what it is the emotional elephant. They're not riding the elephant. The elephant's throwing them around. They're not in control. And that is hard for the average investor to overcome.
So you're like, as a financial advisor, you're more of an elephant trainer, right?
I can be.
You're taking over the hard part and steering that elephant.
Some of them run
direction.
around. Yeah, some of them run around breaking furniture too. It's really annoying, but yeah.
I think a lot of that. This is just me speculating, but just the color red is so intense. Mm-hmm. When you see the line goes down, everything turns red. Can we move it to like a purple, or I just wonder if that would make a difference if it was. Oh, things are chartreuse right now. Like I can calm down a little bit.
You might be right there, but now we get back to the media, right? So you never see the headline "Plane lands safely" because nobody cares, right? Except for that Scully guy when he did it once in the Hudson. But other than that, you never hear that because nobody cares. Bad news sells. We know that in media, and so you have to kind of filter what you're reading as well, or what you're hearing and who you're hearing it from. Because if the market goes up 5% tomorrow, you'll read market recovers. If the market drops 5% today, you hear market plummets. The market either plummets or it has an okay day. There's no in between. So again, how you process and filter information is critical to, I hate to say it, to your investment success quite often.
Whew. So I'm scared, right? Hypothetically, not me really, obviously.
You do look a little nervous, I have to say.
What is the absolute worst thing I can do right now to affect me financially? Like all this is going on, I'm scared. I'm like, I got to do something.
You don't have to do something.
Oh.
That's the beauty. You've already done it. If you're saving, the average person has the majority of their liquid net worth in their 401k or some kind of retirement plan at work. Just keep adding. There's nothing's going to. You're contributing, so you're actually buying cheaper shares right now. So if you just keep, what I've seen historically, and doing this for 35 years, is I've watched plans implode because there was no advisor on premise to tell the participants at XYZ company, listen, the worst thing you could do today is stop contributing. And then they get out, or they move the money to the stable value product or the money market. And I'm not telling you that might not make some sense in certain situations. That's an individual thing. But on average, that does not make sense. And that's where people go awry. And we get back to how we started the conversation. The money is in the risk. With minus the fluctuation, minus the opportunity to buy some shares at 5 and some shares at 2, it doesn't work. You have to have the risk in the markets to get the disproportionate gains. You should welcome as an investor, if you're 35 or 42 or even 55, really even if you're 60 and you're putting money in a 401k, you should be like, cool, let's load the boat. You should be doing the opposite of what your emotions are telling you to do.
Oh, man. It's like my dating life. Okay. It's just interesting because I remember 9/11, right? And 9/11, I was a young kid, but I had a bank account, right? And I remember running to the ATM and pulling all of my money out of the ATM. Why did I do that? I don't know. I think I saw it on the news or like somebody said to do that. So I rode my bike to a bank and pulled all of my money out. And then I bounced like 3 checks. Yeah. So that fear will get you. And I see like when I watch the news, like Ukraine, they're running to grab their money, pulling it out of banks. That is not what you want to do.
Well, I mean, I can't speak to the Ukraine.
Well,
that might not be a bad idea there. But the reality is, if the banking infrastructure is failing, this goes back to some people think there's this kind of apocalypse. Like we'll just kind of have an apocalypse,
a semi-apocalypse.
But I'll be okay because I took my money out of the bank, or Scott put me in this apocalyptic free investment category. It's, I was teasing a guy once because he was kind of in that frantic category a few years ago. Wow, the world's coming to the end, and these politicians are ruining the country, and it's all going to go to hell. Well, all right, so what you're saying to me is that I'm going to put you in this investment that you think is bulletproof, pun intended, and someday they're going to walk up to your door, these bad people that you're talking about, and they're going to knock, hey, listen, we're here for your stuff. And you're going to go, no, hold on a minute. I have the apocalyptic free fund that Scott put me in, so therefore you can't take my stuff. And they're going to go, oh, okay, well, we'll just move on to the next house, right? That's not a thing. If the economy ends, if the meteor hits, listen, people, when the world ends, it just ends. Your stocks aren't going to help you.
Yeah, even it didn't work out for Egyptian pharaohs anyways. They took all of their stuff, they hid it in a triangle, and then, 1,000 years later, we're taking out their stuff actively, and then we're like, look at their stuff.
Yeah.
So there's no be all end all, I suppose. But if you want to do it be smart about it, which is all I want to do after I talk to you every week, Scott, is I go to edgewaterfamilywealth.com, or you can give Scott a call at 407-648-1881. Scott, always a pleasure to talk to you.
Likewise. Good to see you.
Good to see you. And thank you, Tammy, as well.
Thank you.
Yeah, and clearly people are rich, right? Or wealthy. You don't have to be rich. I like the term wealthy better. I mean, to rich reminds me of like the Monopoly guy or something. But, there are people, there are regular people.
Now that guy I trust.
Yeah,
See, the problem, Scott, you don't have a monocle.
Monocle is, now, if you can meet a guy with a monocle, I mean, like, I'm all in.
What was his financial advice? He said buy Park Place?
Where is that?
Where is that? I can't find it.
Tune in to It's Only Money with Scott Brown from Edgewater Family Wealth, Sunday mornings at 7 on Real Radio 104.1. Raymond James Financial Services, Inc., member FINRA SIPC. Edgewater Family Wealth is not a broker-dealer, is independent of RJFS.